Welcome everyone to this week's edition of Commercial Real Estate 101. For those of you guys who are tuning in for the first time, this is a meetup group that we started back in April of 2020 that the focus point is to become really the go-to resource for all commercial real estate related topics. And so every other week, we invite speakers to talk about commercial real estate concepts. And today we have the honor of having Larry Pendleton. He's a CPA with a real strong focus point with investors and business owners. So I'm excited to talk to you a little bit about your experience and your background. And, hopefully you can share some great insights that the people on this call and those that are watching live on other social media platforms as well can gain some value from. So Larry, welcome.
Appreciate it, Raphael. I'm glad to be up here. And excuse the background noise. I think that's my computer trying to cool down.
Yeah, no, for those of you guys who don't know, so Larry is actually in the midst of tax season. So he's been, I'm assuming, working heavily on different returns for his different investors and business owners. So that noise, that slight noise here in the background is the fan in his computer. So awesome.
Yeah.
Well,
Yeah.
yeah. So one of the things we like to do when we first get started is to learn a little bit more about you as an individual. So can you tell us a little bit about yourself and just kind of go from there?
Oh, yes. Born and raised in southeastern Virginia. For those familiar, Hampton Roads, Norfolk, Virginia Beach area. I've been a CPA for over 8 years. I've been doing tax consulting, tax planning, financial reporting, audits, and whatnot for over a decade now. Started PC Financials roughly around 7 years ago. Then start off with kind of focusing on real estate probably until about 3 years ago, but that was after kind of getting the investment bug myself roughly 6 years ago. Pretty linear approach, as with most people. Just start off with a small single family rental. Thought I was doing really well with that. Jumped to the flip game. Jumped out of the flip game. just didn't work out well for me at that time. And then started to look more into multifamily around 2017, 2018, and then kind of got connected to various investment groups, multifamily masters, multifamily matrix, and being able to kind of just connect with more investors. So roughly 3 years ago, it just made more sense to start to shift the tax business, which is PC Financials, with my partner Terry on Conyers, to focus more on professionals in real estate. We typically like to say that any tax real estate strategy within real estate, we can be a great asset to investors, and how to reduce their tax bill as much as possible.
For sure. No, yeah, of course, legally, no, for sure. But there's definitely ways that you can interpret the tax law to make sure that you're able to save a sizable amount in taxes. So, I mean, I think that you're gonna be able to provide a ton of value on that front as well, just in today's call. So, one of the things I wanted to ask you was, tell us a little bit about what the day in the life of your accounting business is. I mean, what exactly does a real estate accountant do?
Um, I say for me, because I'm also an investor myself, I've connected with multiple deals, over 50 doors within the southeastern states. Um, I get to see both sides of the fence. Like, does this deal make sense from an investment standpoint? And then from there, what are the tax implications from that? So a lot of it is just still reviewing deals, underwriting deals just like everybody else, but I'm also sharpening my tools regarding the tax strategies to mitigate those um, the income that you'll make from real estate, and potentially how it can somewhat offset some of your um, W-2 self-employment income if it's not in real estate as well. So most times there's a lot of consulting that we're doing, planning and strategizing, leveraging plans that we set for one client to clients in similar situations, and just kind of, okay, this is a new unique situation. Let's kind of make sure we review the tax code a bit deeper to make sure we're all in the same, all in the up and up if we go down this approach here. Because it's not really aggressive for what we're saying. It's really more we're just following the law as is. People just are not used to having these huge deductions depending what your strategy that we're implementing, because it's not taught too often. So see ourselves more as kind of an educator for our clients to make them feel more comfortable about the approaches that we're taking.
Yeah, for sure. So you're more of an advisor. You start from the beginning of the process where you're involved with I'm assuming as you go through the process of doing the underwriting with the client, you're kind of advising them as far as what the potential tax implications could be given different scenarios. And at that point, you kind of give them the opportunity to say, hey, this is an appropriate route to take, or this may be a better route to take. Is that correct? Or
Right, right. And we're not telling them whether it's a good deal or not,
no, of course not. Yeah.
unless they're asking that, because if it's a bad deal, it doesn't matter what the tax savings are, it's a bad deal. Like I said, we definitely do not want the tax implications pressing whether or not it's a good deal. Like if it's something making over 30% returns, okay, we'll do what we can, depending on the type of income that you're making, to offset as much of that as possible. But it may be some taxes to be owed on the back end. But that doesn't mean it's a bad deal. So we definitely make sure that's first and foremost that it's a good deal, and then here's where we go with a tax plan from this standpoint.
Awesome. It makes complete sense. So when you're working with someone who's new to either the new to the business, or maybe they're transitioning away from a prior accounting relationship, like what are some of the common missteps that you see investors make when tax planning?
I mean, a lot of times they've already made the deal and have not consulted with their tax advisor, whether it's us or whoever. And once again, like, it's not whether or not it's a good deal or not. It's just be prepared for these things. So a lot of the missteps is just, okay, there's just a lack of communication before the deal is finalized, to know, okay, here's what's going to be on the back end. And now that we know what could potentially be on the back end, here's all the additional strategies that can be implemented going forward to help offset those potential gains or income that you have coming in. So we see that quite a bit, and we also see a lot of bit, not a lot of bit, but a lot of people jumping into corporation status too early, or putting properties in corporations where there's no tax benefit there. You're actually making more tax implications from that standpoint. So unless you're just primarily wholesaling or flipping, or just an agent, if you're in the buying and hold side of things, you definitely want to keep those properties out of corporations as much as possible. And if you are on the wholesale flipping side, or being a brokerage or agent, then there's an income threshold, net income threshold, when it makes more sense, because at the end of the day, you're still filing a separate tax return from your personal, so that catch people off guard as well. So we want to make sure that we're informing people of those implications when they're reaching out for consulting purposes.
For sure. Yeah. And that leads us great to our next question. So like, what are some of the tax implications of the different corporate structures? Because that's one of the things that a lot of people that I've interacted with ask. They're like, oh, should I put this in an LLC? And obviously not the legal side. I'm not referencing the legal side, more so just the tax implications of acquiring a property via an LLC, an S corp, et cetera. Could you kind of elaborate a little bit on those?
All right. So your LLC is fairly similar to if you just had it in your personal name. It's considered a disregarded pass-through entity. That means, like I say, if it's just a single member LLC, it'll just be reported on your personal tax return. There's no additional tax savings or anything like that. Now, if it's a partnership LLC, then there will be a separate 1065 form that would be filed, and you have to report the K1s that tax return produces on your personal tax return. But there's no special implications there. It's just, once again, a disregarded pass-through entity from that standpoint. S corporations are also pass-through, but they're not disregarded. There is a separate tax return that, even if you were a single member S corp LLC tax as an S corp. So it's more of a election status, not so much of a corporation. So, but with that, you're saying that you're completely separated from the business, and then you have to pay yourself a reasonable salary or wage, and then you'll still get a K1 on any distributions, any income left over from that standpoint there. Once again, you can probably get into more like, hey, fringe benefits with corporations that you can with LLCs, as well as pay yourself a salary, which you don't do with an LLC either for yourself. And then your C corps, those are just fully separated. They have their own tax bracket. There's no K1's issue, but you are, like, if any distributions, unless there are distributions that are made, then you're taxed on that. You're taxed on your salary that you pay yourself in your C corp, and then your C corp pays. I think the tax bracket at this point right now is 21%. So the timing of when to start from just reporting as an individual, putting stuff into LLC, and potentially being an S corp is all case by case. So at a high level, those are how those corporations, LLCs, are broken out from that standpoint.
For sure, yeah, and like you said, it is very case specific, and that's some of the things. That's why at the beginning, accountant involved is so important. I'm in the commercial real estate brokerage business, and we did like a cost benefit analysis of me just operating as a normal, like, I don't remember the exact structure, but right now I'm operating as an S corp and paying myself a particular salary, and then additional on top of that, if I want to draw essentially on top of that, then obviously there's some different tax implications along with that. But that's all through the process of just interacting with an accountant and saying, okay, what's the best situation for me? And obviously you want to incorporate maybe even a real estate lawyer to make sure that you're protected from a liability perspective as well. So having that team in place is critical. So that's some great advice. So what are some of the most powerful tax strategies for investors? And we've had Yona Weiss, which I believe you know as well, on. There's definitely tax implications there. But could you talk a little bit about the various different types of tax strategies that investors use in order to maximize, the capital accumulation piece?
I mean, if you had Yona Weiss from Madison Specs on, like, that kind of rolls into the whole cost segregation. The best way I like to explain it is that you're taking the cost of the building instead of putting it into the normal 27.5 or 39 year, depending on what the property is used for, depreciation bucket. You're now breaking it out into 5, 7, 15 year tax buckets, which means you get accelerated depreciation at a higher rate, which increases your expenses from a paper loss perspective, as well as maximizing the 2017 tax changes, and then anything that depreciates less than 20 years being fully depreciated in year one. So you have a huge opportunity to see 10, 20, possibly 30%, if not more, depending on the type of investment that you get into, that can be deducted in year one through depreciation. The value of the cost of the building, or the cost base of the building, being written off in year one. So very, very, very strong tool there that investors should be taking advantage of as they're able to acquire more stuff, and especially at the prices that some investors are kind of getting stuff at now. Another tool, I mean, everyone's on the a lot of rumbling in DC regarding 1031 exchanges. Basically, you're rolling the gains from one property that you sold and up to another one there, and deferring those gains down the road. We'll see what we'll see what the government does, I guess, over these next few months, regarding that, whether that's going to still be on the chopping block, or they're altering in some type of way. But a huge tool to kind of be able to trade up, get something that's higher, get something that may be producing more income, without paying taxes on what you just sold there. And just kick that can down the road, and you can constantly keep 1031 in. It's sometimes called the swap till you drop. Not to get too morbid here, but then you have, what the next strategy to that is that if you hold the property at your death and then pass it down to your children, they get to take advantage of the step up basis there. Another strong strategy, that, like, all the gains, all the appreciation that the property has accumulated throughout the years, the heirs get it. They get it valued at that date of death, and are able to start over depreciation at that point. So they get a property at a higher value. So if they sell it at that whatever price they want, they're not paying that gain on their appreciation there, just whatever they end up selling it for. If they decide to hold it, they can start over depreciation, be able to keep depreciating from there, as well as maximize cost segregation on top of that. So you're able to kind of layer additional strategies with that. Opportunity zones are still a hot button right now. I like to call it 1031 on steroids, to be able to defer those gains into that, and and then the gains on the property on the next one, if you decide to hold it per the requirements, are now tax free on that one. So there's like there's another strong one there for those that are in it for the long haul and can have their capital kind of sit for that perspective there. So that's a few that we typically like to shoot towards people as well in regards to how they're acquiring their properties and breaking out depreciation from there.
Sure. Have you seen any activity as far as installment sales goes by chance, or is that something that it's not as common that you've seen?
I see installment sales, and the premise is more time I'm seeing it on the back end with clients that are actually buying it, not so much with the clients that are selling it. But you do have that concept of, okay, we're just going to break the gains out across multiple years from that standpoint, and you only tax on the principal or I guess the principal amount that you received that particular year. So yeah, another way to kind of not eliminate, but you're somewhat
Pushing
taking
the
it in
can down the road.
smaller chunks and not swallowing the whole elephant.
Yeah, exactly. And you kick the can down, not kick the can down the road, but you're essentially you're limiting the influx of your earnings within 1 year and spreading it out over a longer period, thus,
Right.
spreading out your tax implications. So that's something that could be beneficial, especially like you said, if you're looking to acquire property and have someone become, the seller become the bank essentially, and you just are the one who is acquiring the property and paying the owner over a period of time. So
Yep.
that's awesome. So another subsect of individuals that listen to the podcast are also business owners. So they're either real estate professionals, developers, etc. And there are some tax implications for business owners as well. So can you kind of talk a little bit about, some of the strategies that you see, business owners take advantage of in order to limit their outflow, I guess their tax implications or tax obligations.
Right. So I'll kind of use you as an example since you brought it up earlier of you are a LLC being taxed as an S corp. You're paying yourself a salary. You're working with your advisor on that. So the general purpose of that is that the brokerage income that you're receiving is considered non-passive and subject to self-employment taxes, which is as of today 15.3%. So one way to mitigate that is to do an S corp election, pay yourself a salary so that the um what you're paying yourself, that is what's eating up the payroll taxes at that point. So whatever you end up netting at the end of the year and issuing a K1 to yourself, it's still subject to your effective tax rate on your tax return, but it's not that on top of, I mean, with another 15.3% being taxed on top of that. So another opportunity there for a business owner, if it's worth it. Like if you're only netting 10, 20,000 a year, it's not worth it to roll everything into do an S corp election. My threshold is netting $50,000. I know CPA and advisors that do less. I know that some that do more. For me, I just like the clean number at 50,000, where it's actually worth the cost of basically paying for a separate tax return, setting up a salary for yourself. So there's a cost and time factor of it as well. And it's good to kind of be aware of that before you just start issuing yourself or do those type of elections there. So also with business owners, like I said, I mean, I know people kind of get into retirement accounts and traditional being able to get the deductions there, but health savings accounts are another great deductions, whether um, partnerships or not. Like that kind of helps as well if you have kids, and being able to hire them as employees, not 1099, but actual employees, so that one, you get the 12,200 at this moment, up to that to the deduction, and then they're not having to pay any FICA and Medicare tax from that standpoint there, because they're working under mommy and daddy at that time. So, and then for those business owners that actually have like a real property trader business, like if I'm rather get you're actually a broker of properties, not a lending broker. The fact that you actually are dealing with the properties themselves, like, and you in a real, so flippers, brokers, agents, even wholesalers, so a real property trader business, and you're starting to get into more of, okay, are you a real estate professional at that point? And that's the 750 hours in at least more than half your work time in a real property trade or business, that you own at least 10% of at that point. So now you qualify for a real estate professional. Now you're making your money off of that business that's non-passive, but now you're able to get um, more into when you get more into the buy and hold aspect of things, because that's when depreciation kind of comes into factor and be able to drive up those passive losses from your real estate. So now your rental real estate is generating losses. You qualify for a real estate professional status, and you are materially participating in your portfolio, basically involved in the day-to-day operations of the property, so that now you have the losses offsetting your business income.
100%. Yeah, I know. And that's one of the most powerful things about being a real estate professional, in particular if you also invest in properties, that you can use the depreciation that you take on other properties to offset not only your passive income through those real estate properties, but also, your business income, which is great. Because I know that's not the case if you're just a passive investor. Is that correct?
Yeah, so you're just a passive investor. You're not. You can. A lot of people. I do syndications as well. We tell our investors, hey, you'll get these huge losses, so you're not paying taxes on the income on the distribution that you make. But that doesn't mean all those losses are going to be able to be recognized on your tax return. Now they don't just go away; they're suspended and roll forward in the future years. But if you're passively involved, not materially participating or actively involved with your own portfolio, you can't really claim material participation. And if you don't have it, so you don't really get that, or the aspect of being a real estate professional there. So you are limited to that standpoint. We do recommend to our LPs to kind of look into short-term rental investing as well, where if your property is rented out for 7 days or less, part of the code 469 of the IRS is that is still considered passive, but the losses are also, it kind of plays on both sides of the fence, where you can now claim a non-passive activity at that point, even though it's still somewhat passive, but you still got to be materially participating. You got to be real estate professional status. You can skate around requirement 1 and 2 with the 750 and 50%, but you still got to prove material participation from there. And there's 7 or 9 different guidelines on that, but the easiest one that we have seen people reach is 500 hours, and that's involving the actual whether it's dealing with the building itself or with the people in your rental property. So we try to get our investors to get somewhat involved in the game from an active side, and have portfolios that you are owning, and not just investing in somebody else's deal passively.
Sure. Yeah. And I one thing, just as a side question, let's say that you are a real estate professional, right? And your spouse is not. They have another job that they perform as well. Let's say you and your business, or if you're investing in real estate, on the side, can you use some of the depreciation to offset both your income and your spouse's income, or is that just for, your side of the equation, I guess?
Yeah, I think if it was that way, it'd be a lot more married family separately at that
Yeah.
point. But no,
Yeah.
no, it's so only one spouse has to be real estate professional for that to be qualified. But then material participation, both spouses can now contribute hours into that bucket, and then any losses from your passive activity can now offset even your W-2 spouse's income.
Awesome. That's a powerful strategy. That's great. So one of the things I wanted to ask you pertaining to what we had talked about earlier was all the talks of different laws that are coming down the pike, and the changes of different tax regulations. So could you tell us a little bit about maybe some of the things that you see coming down the pike, or if you can, because I've talked to several accountants, and they're just kind of like, it's all up in the air right now. Like, people are kind of trying to,
And they're right. Because 1031 exchange is going away. That's not the first time that's ever happened. Typically, there's a lot of lobbyists involved on the real estate end that have the money and resources to kind of get the votes swinging in the right direction for us. But like I said, yeah, that becomes a potential there of if they're just going to completely get rid of it, or they're going to alter it over a certain dollar threshold that can be 1031 over, or anything below that can be 1031. Everything has to be paid at that point. The step up basis is also has also been on the chopping block or alteration board as well. Of okay, they can get up to a certain amount, but anything above that, okay, they don't get any additional benefits of just kind of rolling that over there. So, um, so that creates an interesting situation of how people will treat that, of maybe doing a charitable remainder trust and stuff like that to okay how to get the property moved over before the owner passes away. So from that standpoint there. Um, with the 2017 tax changes, there are some sunsets that are happening. One being the 100% bonus depreciation that we talked about earlier, where at December 31st, 2022, it starts to sunset or phases down 20%. So now it was 100% for the next year and 4 months, and then after that it goes down to 80%, and it goes down to 20% year after year, and then we'll see by once they get close to that 50% mark, that's where it used to be at 50%. Let's see if Congress brings it back to the table and extend portions of it, or bring it back to what it was before 2017, or raise it back up. So we'll see from that perspective there.
Awesome. Yeah, those are some definitely things to watch out for the next couple of years, because it will have an impact on decision making for investors and business owners alike. So
yep,
that's awesome. So before we open up to Q&A, I had one final question, and then we'll get to you guys. If you guys are interested in asking some questions, feel free to type away in the chat box. If you guys are watching us on Facebook, please do so as well. But the last question I wanted to ask you was, what are some of the best resources for those individuals that are interested in learning more about tax strategies they can implement or employ as a real estate investor or a business owner?
they can read the IRS code. It's all there. Oh no,
That
I mean Brandon Hall, from the real estate CPA, like they put out a lot of good content. Like their Facebook group, Tax Smart Investors is a good one. Another gentleman named Brand, I can't think of his last name, but it's uh, tax strategy for real estate investors. So there's a lot of different Facebook groups that there's open discussions regarding stuff like this, as well. So typically Bigger Pockets, and you kind of come across Amanda Hahn in there, and she puts out a lot of good information regarding that. So really good resources there. And then it's really more of if you can really re-interview your current tax advisor to see like if he or she is competent in real estate and taxes, so that you have a go source. Now, okay, would they charge for that type of like consulting? Like it all depends on how much time you're spending at that point with them. But like I say, you have someone that you're close to that's already know. If not, then you may have to kind of find someone else that you can kind of just go directly to, for that type of consulting or whatever transaction you have going on.
Of course, and not all accountants would be a good fit for everyone, like you're saying. I mean, you love dealing with real estate professionals and investors, and that's kind of your focus area. And there's other accountants that focus on other types of uses. So it's one of those things where having that conversation with your tax professional is huge. And that's a great piece of advice. I also read this book, which just for those of you guys who are interested, it's the title's kind of aggressive, but it's called Aggressive Tax Avoidance. It's not really like anything illegal or anything, but this gentleman's named John T. Reed. He's an impressive guy. And so I read that book, and it actually had a lot of the same strategies we talked about and really dove through the tax code. Because I don't know, the idea of reading the tax code to me is very, very much something I'm not interested in. But this guy went in and, references sections, and I'm just like, oh. But
Yeah,
awesome.
I mean, you got Tom Realwright's Tax Free Wealth.
Yeah, that's a good one too.
You have Amanda Hahn's tax strategy for the savvy real estate investor, as well. They actually got two books, pretty similar name. They have a part two to their book. So, like I say, those are solid books to kind of like if you want to look into the audio book or just something you can kind of hold and read and just have a reference point to go to, are solid resources as well.
Awesome. Great. So yeah, now what we'll go ahead and do is we'll open it up to the Q&A section. Looks like we have several questions in the chat box, so I'll go ahead and read those off. So is it Angel, right? Angel. Awesome. So Angel asks, can you go back over the paying your children part and the amounts for 2020 and 2021?
Hey, Angel, it's been a while since we chat. Is your hair still purple? Oh, yes, it is. Nice. My favorite color.
You just can't see it because I have it pulled back. But
Okay,
yeah, it's still blue and purple.
There you go. I see it now. There we go. All good. All good. So when it comes to paying your children, the reason why you want to avoid the 1099 is that we're trying to avoid any additional tax that they would have to pay. And when you 1099 someone, even if it's less than the standard deduction of 12,000, I know it's 12,000 some change, but let's just say 12,000 for the sake of this conversation. Whatever you pay them is already the self-employment tax is already applied before any deductions are accounted for. So they would have to pay the self-employment tax, even though their tax return may net to zero with the standard deduction. So the W-2 side of things is that as long as they can be claimed as dependent, it's just your business. It's not a partnership with other people. It's yours, and like you W-2 them out of that business, and then and then they are now exempt from FICA, Medicare, all the lovely taxes that we enjoy paying with our W-2 jobs.
Awesome. All right. So sorry, I'm typing in the chat box. There was someone who was asking about the different books that we referenced. And so I'm typing the 3 books that we referenced in the chat box. And I'll include these also in the description below if you guys are going to be watching this on YouTube or listening to this in a podcast format. So that'll be available to you guys as well. There was a question referring to the depreciate. So do you know how bonus depreciation / cost segregation will be affected once those roll off in the next 2 to 3 years? I know you referenced somewhat related to the bonus depreciation, but could you reference maybe cost segregation?
Yeah. So the bonus depreciation is really for it's 100% bonus depreciation as of now until December 31st, 2022, and then so that means anything depreciates less than 20 years, you can just roll all the depreciation into year 1. Very powerful stuff. So to that question is that instead of it being 100%, let's say now we're in January 31st, you acquire something in 2023, only 80% of it can be now recognized up front. Still can be pretty significant at that point, and then the year after that it'll be 60%. And then I said it has spiked up before, and typically Congress has elected to keep it at 50% or around that rough range. So I'll be surprised if it's completely expired and there's no more bonus depreciation to take advantage of at this point. So especially as they're trying to continue to incentivize investors to buy properties, renovate them. I mean, that's the premise of the tax code itself, is just to be a bunch of incentives to get people to move a certain way. Hopefully that answers the question.
Oh, that was a great answer. Awesome. All right. So another question. Angela has another question. So we have an employee. Okay. So we have an employee wanting to move from 1099 to W-2. Is there a way to do this that won't set both of us back by thousands for 2021? Or is there a hint I can give that employee that doesn't trash her earnings?
So they want to move from a 1099 to W-2, so you have a bit of an HR situation there, and getting them set up and registered with the state there.
I guess my other question is do we have to do it for the entirety of 2021, or can we do it? She asked if we could do it like a few months ago. So could we back up and do half the year at 1099 and half the year at W-2? Her dad, who is an accountant, told her, do 1099. You'll be happier with it. She is not happier with it. So she wants it taken out monthly so it doesn't hit her all at once. because they go to like H&R Block, and I said, honey, your first problem is going to H&R Block.
There's nothing wrong with H&R Block. There's no reason to throw them under the bus. They good folk there. I mean,
Okay.
you just have to know what you getting there. Like I said, if I'm gonna go to McDonald's, I mean, I'm not gonna get a smoothie. Like that's just things I just know I'm not gonna get there. So I mean, the premise of that, and I've heard it before. People are like, man, I'm just gonna go 1099 and entirely tax it. Like, hey, yes, you can go 1099, not have the taxes taken out. I like to throw in Robert Kiyosaki's cash flow quadrant into it because you really have to know how each of the sectors are being taxed. At a high level, employees are being taxed at roughly 30-40% of their income. Self-employed employees or 1099 employees are being taxed somewhere at 50-60% of their income because it's not just their tax bracket, is also that 15.3% that we talked about before that they're being taxed on there. So when people are advised like, hey, you get to avoid all these taxes, like, yes, you now have to pay taxes now, that bill is still due. Now, I don't advise people against it. It's if you're going to go down this route, you better have some assets you're going to be buying, because you will need every write-off that you can at that point to offset the fact that you have not paid, and you're still going to pay at least 15.3% because, like I said, you're getting 1099 at that point, and that doesn't factor whatever your net amount is for your business. So as long as you have a strategy behind going 1099, that's fine. Just blankly tell people to go 1099. I won't call her dead reckless, but it's.
But I don't think he told her to itemize either. So they're doing standard, and I don't think that's going to help. And I told her, I said, if you want a 1099, great, but you need to be setting aside some money every month so that when your tax bill comes due, you don't freak.
Yeah, you should charge her for the information. Let's get it. But yeah, so I mean, even the itemized aspect of it is not whether or not. I always tell people itemize if you can. The question is if you can. If you're married, filing jointly, the standard deduction is $24,000. Do you have over $24,000 of donations, medical expenses, taxes paid, insurance? Well, if you live in California, you may have enough real estate taxes paid to cover that. But as it becomes this bucket of stuff, like if you can exceed that, go ahead and exceed that. If you can't, then it doesn't matter at that point. Because you're not going to take a lower deduction just to say you itemize. That's just a waste of everybody's time at that point. So like I said, I mean, yeah, I think you just the roll. I think that you have to just roll her back over to W-2. What she would have to do is probably claim like if her strategy now is to just pay taxes now to mitigate her bill, she just have to adjust her withholdings. So that she can have more taxes taken out to account for the fact that half the year she has none taken out. Now that's, for me, that's lazy advice, but my approach to her is like, you've been sitting on this capital, you may want to go ahead and buy an asset and leverage the tax code to help deduct that from there. That's just me.
Yeah.
Who am I?
She's not very I don't think she's very savvy when it comes to that, but she's really great at managing our home office, so we don't worry about it.
Yeah.
She just doesn't have a lot of financial, I don't want to say financial sense, just she doesn't have a lot of financial know-how, and her dad doesn't seem to be guiding her. Like, he tells her what to do, but he doesn't give her reasons.
Mm-hmm.
Yeah.
I think that's a lot of times like I said, I don't want to throw any shade on anyone. I mean, you do have a lot of a blind leading the blind type of aspect of stuff going on. That's why I say it's helpful to kind of get with the right individual, know the reason why, and I'm assuming he's doing her tax return and signing off on him, because it's very
no, because he won't do them. He's in Washington and he won't do them, but he gives her tax advice. We're in Texas, by the way.
Yeah, I imagine. So yeah, but I mean, one thing I would say, just as a, having run my own business for a couple of years now, I read this book called Profit First, that talks about how to allocate.
I actually have that. I could loan it to her.
You should, because that's how I was able to kind of maximize. And the premise of Profit First is you have several accounts that you set up to be able to put bucket. You have buckets essentially. You put in your owner's compensation, you put in your operating expenses, you put in your, the tax account and everything else. And every time money comes in, you allocate it towards one of these accounts in order to make sure you have enough for your operations, for your owner's compensation, your salary essentially, and your taxes as well. So that was a great book for me, and it utilized the premise of like bank account financing, where it's like people just look at their bank account, they're like, oh, I got the money in there, and it's like, great, I can spend it. But in reality, a portion of that needs to go to taxes and whatever else. So if you can separate them from the different accounts, it's actually more efficient that way. So
I have one more question.
Yeah.
Would you suggest, like, should I take some time to explain to her that 1099 is probably pretty good right now, especially since we're probably going to go through a pretty substantial inflationary period, and she would much rather be paying her taxes in dollars at the end of the year than at the beginning of the year?
I get it kind of goes back to Raphael's point of, but that's a discipline to that book as well. I mean, that's what the main thing that book, like, you can do all these things, like, hey, you can create 5 different bank accounts, but you have to mentally go and do that, and then once it's in there, you don't touch it, unless there's a obviously emergency situation that comes up. So, like I said, without knowing the individual, like I said, I'm just like, have no clue who this person is. And
stereotypical millennial.
I'm sorry.
I don't
stereotypical millennial.
I don't know what that means.
Well, I'm a millennial, so.
Yeah, but you're not stereotypical.
Okay. But yeah,
I think for her, like I said, it sounds like it's just to kind of put things in autopilot, and it's kind of until that discipline, that mindset is kind of better established there. Because like it's no different than, let's say you go to you got private lenders that's just pulling out the whole money to their borrowers. Okay, does that borrower like have the mental capacity to be a good steward with that money and do what it's supposed to, and have everything going where it needs to go? So you'll have a better judgment of that of her than I can at this point. So like I said, I just see it more as just kind of, let's just go safe. Let's get everything back on autopilot for everything kind of getting paid for to help minimize it on the back end. And then let's revisit it. Let's revisit it down the road.
Great advice. Yeah. And it's case by case, and I think that's kind of the advice there. But Mark actually had another question that I thought we'd get to. So he said, Larry, you mentioned the 1031 exchange may be changing or going away. Any thoughts on possible changes to self-directed IRAs? Great question.
Yeah, they have. I think I started posting this in random groups of people to reach out to their congressmen, and kind of like just because they're trying to get into retirement accounts and tax people on the gains in there, and make it very difficult to invest out of that as well. So, like, I mean, that one has probably people as much riled up as 1031s, especially now. Them trying to get into this weird aspect of them trying to get into retirement accounts as well as bank accounts, to kind of I guess they want to call it a tax, a wealth tax, but it's going to affect everyone. So, like I said, it's a lot of smoke right now. Whether there's an actual fire that actually gets past at that point, we'll see. Like, but that's going to adjust where people will start putting their money into, whether it's going to be into a retirement account or some other type of account to help grow tax free from that standpoint there.
Yeah, and that's kind of the feedback I've been getting from a lot of different accountants that I know, and it's like, it seems like every day there's some update as far as what's going to be happening, but nothing's set in stone as of yet. So, keeping up to date as far as the different progress, I'm assuming, is something that could be prevalent, but we really don't know at this point in time. But
yeah, it hasn't been much change other than just to talk about it at this moment.
Yeah, for sure. Awesome. Do you have any other questions from the audience? I'm also checking Facebook, so if you guys are watching on Facebook, feel free to type away.
I got a question.
Yeah, sure.
Is there a certain section that focus in the tax code that focuses on real estate? Is that like to narrow it down to not have to read it all?
I mean, yeah, if you want to dive into it, Section 469 kind of dives more into the passive income side of things, and that's where most real estate investors are going to fall into. The buying and hold real estate investors are going to fall into that realm. It covers other types. I mean, it's just passive income in general, because you can be passively involved in a laundromat and be subject to the same laws, but when you're talking about buying whole real estate, then the income that you make and the losses that you incur from it are going to kind of fall into there.
Thank you.
Thank you.
Great question. All right. Awesome. So Cassandra, she asked to summarize today's meeting. Well, we'll do it even better. How about this? So this is actually going to be recorded. So if you'd like to go back and kind of go over some of the talking points that we had in today's meeting, be happy to, it's going to be available tomorrow. So that'll do you one better. So you can keep watching and watching and watching.
I can one, like find a tax advisor that knows real estate. 2, educate yourself on buying real estate. 3, buy real estate. That's a great summary there.
That's a great summary. Yeah. And it's simple, right? Just follow that and do it over and over and over, and you're good to go. That's awesome. All right. Any other question? No, nice. So any other questions before we wrap up? All right. Perfect. So, well, first off, Larry, thank you so much for stopping by and sharing all your insights with the group. We really do appreciate you spending some time with us today. So if people wanted to get in contact with you, learn more about you, etc., what can they do to do so?
Yes, I'm almost on all the social media platforms: LinkedIn, Facebook, Instagram. Typically just Larry Pendleton CPA. I try to make myself easy to find. You can reach out at me at 757-535-8592. This thing is always going off, so give me about 48, 72 hours to respond back to your call or text, and I'm happy to, like I said, just add value where I can.
For sure. Yeah. And for those of you guys who are watching this on Facebook and YouTube and in the podcast format, we're going to include all his contact information, his website, etc., in the description, so you guys can have that as well. So feel free to click away and reach out to Larry if you have any other questions. Awesome. Well, thank you all so much for stopping by. We do appreciate it. We will be meeting every other week. So the next meeting, I believe, actually the next meeting is coming up next week because it's kind of like an odd month. So we'll be meeting on the 7th. So if you guys are interested in checking out, we're going to be talking about self-storage units. So should be a great meetup. And thanks again for stopping by this week. And we'll see you all next time.
Thank you.
See you guys.
Bye, guys. Thanks, Larry. Thanks, Raphael.
Yeah, it was great. It was great seeing you guys.